It is Tuesday, January 27th, 2026. While you were sleeping, or perhaps while you were stuck in traffic worrying about your mortgage payment, something fundamental broke in the Canadian financial system. It wasn't a bank failure. It wasn't a housing crash, at least not directly. It was a silent digital collapse that happened on the currency exchange screens in London, New York, and Tokyo. At approximately 4 o'clock a.m. Eastern Standard Time, the Canadian dollar, our loonie, the symbol of our national economic sovereignty, crashed through a critical psychological floor. It didn't just dip, it plummeted. As of the recording of this video, 1 Canadian dollar buys you exactly 62 US cents. We are trading at levels not seen since the dark days of the early 2000s, but the context today is infinitely worse. We have officially entered the era of the Northern Peso. And while the politicians will try to tell you that a weak dollar is good for exports, do not believe the lie. For a country that imports almost all of its food during the winter, for a country that imports its electronics, its machinery, and its refined fuel, a 62-cent dollar is not a stimulus, it is a catastrophe. It means that effective immediately, you have taken a 30% pay cut relative to the rest of the world. It means that the standard of living in Canada is about to revert to that of a developing nation. And the scariest part, this was done on purpose. To understand why your grocery bill is about to double, we have to look at the monetary trap that the Bank of Canada has walked us into. For the last year, Governor Tiff Macklem has been playing a dangerous game of chicken with the United States Federal Reserve. The U.S. economy, driven by massive productivity and a tech boom, has remained strong. The Federal Reserve has kept interest rates high, around 5%, to fight their own sticky inflation. But Canada is broken. Our economy is in a deep recession. Our housing market is on life support. Our consumers are tapped out. So, the Bank of Canada panic cut interest rates. They slashed rates aggressively to try and save the homeowners from the renewal cliff. They brought our overnight rate down to 3%. But here's the problem. Money flows where it is treated best. Why would a global investor keep their money in Canadian bonds paying 3% when they can move it across the border to US bonds paying 5% with less risk? They wouldn't, and they didn't. We are witnessing a massive capital flight. Billions of dollars are leaving Canada every day, sold for US dollars. When everyone sells loonies and buys greenbacks, the value of the loonie collapses. The Bank of Canada had a choice: save the housing market by cutting rates, or save the currency by keeping rates high. They chose housing. They chose to sacrifice the value of your money to protect the equity of the indebted. Now let's talk about what 62 cents actually looks like at the grocery store. This is what economists call imported inflation. It is January. Look outside. Nothing grows in Canada in January. That cauliflower you see at Loblaws, it comes from California. That bag of oranges, Florida. The lettuce, Arizona. The strawberries, Mexico. All of these global suppliers demand to be paid in US dollars. They do not care about your Canadian mortgage problems. Yesterday, a case of lettuce cost the importer 20 US dollars. At a 75-cent exchange rate, that cost the Canadian importer $26. Today, at 62 cents, that same case costs $32. That is a 25% increase overnight, but it gets worse. The trucking company that brings the food up from the border pays for fuel. Oil is priced in US dollars, so the transport cost goes up. The packaging is often imported. The machinery is imported. By the time that head of cauliflower hits the shelf, the retailer has to mark it up to cover all these currency losses. We are looking at $15 cauliflower. We are looking at $20 packs of ground beef. We are looking at a scenario where food insecurity moves from the margins of society right into the middle-class dining room. This is not transitory inflation caused by supply chains. This is structural inflation caused by the debasement of the currency. You cannot print your way out of this, and you cannot subsidize your way out of it. This currency crash also exposes the massive vulnerability of our energy sector. Canadians love to think we are an energy superpower. We have oil, right? So gas should be cheap? Wrong. We export raw crude oil at a discount, and we import refined gasoline and diesel. And guess what? Refined products are traded globally in US dollars. So when the loonie tanks, the price at the pump skyrockets. We are projecting gas prices to hit $2.50 a liter in the GTA and Vancouver by the spring. Think about what that does to the economy. Every plumber, every delivery driver, every logistics company has to pass that cost on to you. It is a tax on movement. It is a tax on existence. And unlike a government tax, the revenue doesn't go to building hospitals or schools. It evaporates into the currency exchange markets. It is wealth transfer from Canadians to the holders of US dollars. We also need to talk about the brain drain connection, which we touched on in our previous video. A 62-cent dollar is the ultimate accelerator for talent exodus. If you are a software engineer in Waterloo earning 100,000 Canadian dollars, that is now worth only 62,000 US dollars. A company in Austin, Texas can offer you a starting salary of 100,000 US dollars, which is now worth 160,000 Canadian. The gap has widened into a canyon. Why would anyone stay here to earn monopoly money that loses purchasing power every day when they can cross the border and earn the world's reserve currency? The collapsing dollar effectively puts a for sale sign on our entire workforce. US companies are coming in and poaching our best talent for pennies on the dollar. It's a fire sale of human capital, and as the talent leaves, the productivity drops further, which hurts the economy more, which weakens the dollar more. It is a classic doom loop. The impact on Canadian businesses is equally devastating. Any business that relies on imported goods or technology is facing an existential crisis. Let's say you run a manufacturing plant. You need to buy a new machine from Germany or Japan. That machine is priced in euros or yen or USD. Suddenly, your capital expenditure budget has blown up by 30%. You can't afford the machine. So you don't invest. You don't modernize. You become less competitive. Or you are a retailer selling clothes. You buy inventory from Asia. You have to raise prices by 40% just to break even. But the Canadian consumer is broke. They can't pay 40% more. So sales collapse. We are going to see a wave of bankruptcies in the retail and import sectors specifically driven by this currency shock. The Dollarama model stops working when the dollar is worth nothing. But wait, the politicians say a weak dollar is great for tourism and exports. Let's debunk this myth once and for all. Yes, in theory, a cheap currency makes our exports cheaper for foreigners. But what do we export? We export raw materials, lumber, oil, minerals. We are selling off our natural inheritance at a discount. We are holding a going out of business sale for our natural resources. And as for tourism, sure, maybe more Americans will come to Banff for a cheap ski trip. But the service staff who serve them can't afford to live in Banff because their wages are in worthless Canadian dollars while the cost of living is global. And for you, the Canadian citizen, tourism is over. Forget about that trip to Europe. Forget about Disney World. Forget about the winter escape to Florida. With a 62-cent dollar, you are a prisoner in your own country. Your purchasing power stops at the border. We are becoming an insular, isolated economy because we simply cannot afford to participate in the global market. What is terrifying is that the Bank of Canada knows all of this. Tiff Macklem is not stupid. The economists at the Department of Finance are not stupid. They ran the models. They simulated this, and they decided that this was the lesser of two evils. Think about that. They decided that destroying the purchasing power of 30 million people, making food unaffordable, and crushing the standard of living was better than the alternative. What was the alternative? The alternative was keeping interest rates high to defend the dollar. If they had done that, if they had kept rates at 5% to match the US, the housing market would have imploded completely. We're talking about a 50% crash in prices, millions of mortgage defaults, and the insolvency of the big five banks. The Canadian economy is so addicted to cheap debt and high housing prices that the central bank had to sacrifice the currency to save the bubble. They sacrificed your grocery cart to save your neighbor's HELOC. It is the most cynical policy decision in modern Canadian history. This creates a scenario known as stagflationary depression. It is the worst economic condition known to man. Stagflation means the economy is stagnant, high unemployment, low growth, while inflation is high, expensive food and energy. Usually in a recession, prices drop. Not this time. Because the inflation is currency driven, prices will rise while people lose their jobs. Imagine losing your job in the manufacturing sector because the company can't afford imported parts, and then going to the grocery store and finding out that bread is $8 a loaf. That is the reality of 2026. It creates social unrest. It creates crime. When people cannot afford to eat, they do desperate things. We are already seeing a spike in theft at grocery stores. Butter, meat, and baby formula are being locked up behind glass. This is not the Canada we grew up in. This is the hallmark of a failing state. So what happens next? How low can it go? There is no technical support on the charts below 62 cents. If the panic sets in, if the global markets lose faith in Canada's ability to service its debt, we could see the loonie touch 50 cents. It has happened before. But back then, our debt was lower. Today, with household debt at record highs and government debt exploding, a 50-cent dollar would be apocalyptic. It would trigger a sovereign debt crisis. The rating agencies, Moody's, S&P, would downgrade Canada's credit rating. This would increase our borrowing costs, forcing the government to print more money to pay the interest, which devalues the dollar even further. We are staring into the abyss of a currency spiral. We are also seeing the dollarization of the Canadian economy. Smart businesses are starting to quote prices in USD. Contractors working for US clients are demanding to be paid in USD. The real estate market in luxury areas is starting to whisper prices in USD to attract foreign buyers. The Canadian dollar is losing its utility as a store of value. It is becoming merely a transactional token that you get rid of as soon as you receive it. This is how currencies die. They don't disappear overnight, they just become irrelevant. People switch to stable coins, to Bitcoin, to gold, to USD. The local currency becomes the hot potato that nobody wants to hold. For the average Canadian, this is a wake-up call to take defensive action immediately. If you have significant savings in Canadian cash sitting in a low-interest savings account, you are being robbed every single day. The inflation rate is higher than the interest rate. You are losing real purchasing power. You need to diversify. You need to hold assets that are hard. Gold has hit an all-time high in Canadian dollars. Not because gold is more valuable, but because the dollar is less valuable. US stocks, even if they stay flat, go up in value for you because the exchange rate favors them. You need to think like a global citizen, not a local one. Your government has abandoned the defense of your money. You must defend it yourself. The political fallout from this will be massive. The opposition will scream about the Trudeau dollar or the Macklem crash. But rhetoric won't lower the price of milk. The structural damage is done. Rebuilding confidence in a currency takes years, sometimes decades. We have spent 10 years printing money and relying on real estate speculation and ignoring productivity and investment. Now the bill has arrived. The world has looked at Canada's balance sheet and decided that our stock is overpriced. The 62-cent valuation is the market's verdict on the Canadian economy: weak, uncompetitive, and overly indebted. There is a grim irony here. For years, Canadians crossed the border to shop in the US because selection was better. Now, Americans are crossing the border to buy our real estate and our companies because Canada is on sale. We are becoming the discount aisle of North America. Everything must go. Our resources, our homes, our companies, our talent. The crashing dollar is the mechanism of this transfer. It is a liquidation sale of a G7 nation. This is not fear-mongering, dismongering. This is math. Open your banking app. Look at the exchange rate. Look at the price of oil. Look at the interest rate differential. The numbers tell the story. The loonie is a bird with a broken wing, and it is spiraling down. The ground is coming up fast. If you want to survive this currency crisis, you need to stop thinking in CAD. Start calculating your net worth in USD or gold. That will tell you the truth about whether you are getting richer or poorer. And I promise you, for most Canadians, the answer is terrifying. The days of parity are gone. The days of 80 cents are gone. Welcome to the 60-cent reality. Tighten your belts. It's going to be a long, expensive winter. Subscribe to Canada Property Watch. We will keep tracking the collapse of the loonie and telling you the uncomfortable truths about your money that the news ignores. Don't get caught holding the bag.